Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Right now, a massive shift is happening in our backyard. Global companies are pouring billions into ASEAN factories, creating a golden opportunity for Singapore investors. Let me show you how to spot these opportunities and potentially profit from them. Remember when everything seemed to be made in China? Well, that's changing fast. Companies worldwide are adopting what we call a China plus one strategy. They're keeping their Chinese operations, but adding new factories in ASEAN countries. This isn't just a temporary trend, it's a fundamental shift in global manufacturing. Let's look at the numbers, and they're pretty impressive. Last year, ASEAN pulled in $174 billion in manufacturing investments. That's a 15% jump from the previous year. Vietnam alone attracted $27.7 billion in foreign money, while Indonesia secured deals worth $44.2 billion. Even Thailand's Eastern Economic Corridor project has brought in $20 billion for advanced manufacturing. Now you might wonder, where does Singapore fit in all this? Well, we're playing a crucial role, but maybe not in the way you'd expect. While we secured $22.5 billion in fixed asset investments, our real strength lies in being the brain center of this manufacturing boom. Think of Singapore as the command center where companies set up their regional headquarters to manage their ASEAN operations. Let me share a real example that shows how this works. Foxconn, the company that makes iPhones, recently invested $300 million in a new Vietnamese factory. But here's the interesting part. They didn't shut down their Chinese operations. Instead, they're running both. The result? They cut production costs by 30% and created 30,000 new jobs. That's the kind of success story we're seeing more and more. But here's where it gets exciting for us as investors. We've got several ways to tap into this trend. First, look at manufacturing REITs. These are real estate investment trusts that own factories and industrial parks across ASEAN. Some of these REITs are listed right here in Singapore, making them easy to access. Then we've got industrial stocks. These include companies that provide equipment, services, or support to manufacturers. Many are expanding their ASEAN presence right now. And don't forget about regional ETFs that focus on ASEAN growth. They give you broad exposure to this manufacturing boom. But before you rush to invest, let's talk about what you need to watch out for. Each ASEAN country has its own rules and regulations. Infrastructure quality varies widely. What works in Thailand might not work in Indonesia. Labor markets are different too. Some areas have skilled workers but higher costs, while others offer lower costs but might need more training investment. You'll also want to keep an eye on government incentives. Many countries are offering sweet deals to attract manufacturers, but these incentives won't last forever. Smart investors look at the long-term picture, not just current benefits. Here's something many people miss: the ripple effects. When a big manufacturer moves in, it creates opportunities for smaller suppliers, logistics companies, and service providers. Sometimes these supporting act investments can be more profitable than investing in the main manufacturers themselves. Let's break this down into practical steps. First, research ASEAN-focused ETFs and REITs listed on the Singapore Exchange. These often provide good exposure with lower risk. Second, look for Singapore companies that are expanding their manufacturing presence in the region. They understand both local and regional markets. Third, consider the infrastructure players. Companies building or managing industrial parks, power supplies, or transportation networks. Keep in mind that this shift isn't happening overnight. It's a gradual process that could take years to fully play out. That means you've got time to do your homework and build your position gradually. Don't feel pressured to jump in all at once. I've created a special playlist about regional investment opportunities, including a deep dive into specific ASEAN markets. You'll find the link in the description below. Each video breaks down the opportunities and risks in different countries, helping you make more informed decisions. Remember, the key to profiting from this manufacturing shift is understanding that it's not just about factories moving, it's about entire supply chains being rebuilt. This creates multiple layers of investment opportunities, from real estate to technology to logistics. Before I wrap up, here's a practical way to get started. Check out the Lion China Merchants Emerging Asia Select Index ETF. This ETF gives you exposure to emerging Asian markets, including many countries benefiting from this manufacturing shift. It's listed right here in Singapore, making it easily accessible for local investors. As always, do your own research and consider how it fits into your overall investment strategy. That's it for today, friends. If you found this helpful, hit that like button and subscribe for more insights about investing in Singapore and across ASEAN. Drop your questions in the comments below, and I'll see you in the next video.